Hello, everyone, and welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Hiran Amin. How much money do you think you'll need to save for retirement? If that question makes you sweat a bit, you aren't alone. A survey by BMO in February of 2023 found Canadians believe they will need a whopping $1.7 million to retire comfortably. That might feel out of reach for some Canadians, especially for those who haven't started investing until later in life. But there are ways to build a retirement income stream even for investors who are short on time. And today's speaker is a shining example of just that. He didn't start with a huge amount of money, and he only got serious about investing in his early 50s. Yet the investment income he earns each year is more than enough to cover his lifestyle, and it's continued to grow through the 15 years of retirement and counting. He's confident that he'll have more than enough money to meet his retirement needs, no matter how long he lives. So let's find out how he made his retirement dreams come true. Joining us is Henry Ma, founder of the blog Your Ever Growing Income. He's also authored several books on income investing. Henry, it's great to have you back on our program, and thanks for taking the time to chat with us here today.
Hi, Darren. Thank you very much for having me on your show. I appreciate it.
Absolutely. So we're going to come out of the gates here fast. So I wanted to ask you, since we last chatted, what's been keeping you busy in retirement from the last time we heard?
Well, I guess my main activity has been my blog. I probably spend 2 to 3 hours a day either searching for articles or trying to find articles to write about. And it's kind of difficult because I concentrate on one topic, income investing. So I have to try to search for articles that others will find interesting, and I don't end up repeating myself over and over.
Yeah, absolutely. No, I've definitely perused through that blog, so you definitely do have some great content there, and I'm looking forward to unparceling some of that with you today in our chat. The other thing I did want to ask you, let's talk about the current climate that we're in. And a lot of Canadians are fretting about high inflation, a possible economic recession, and with that, a market downturn. How much do you worry about these issues?
Actually, none at all. Um, Income investing for me has proven that I don't need to worry about the market. I don't need to worry about recessions, rising costs. I was fortunate enough to follow a strategy which allowed me to earn more income than we needed in retirement. So once your income level, and again, I don't have a company pension. I only have Canada Pension, Old Age Security. But once we received more investment income than we needed, and it continued to grow, it got to the point where, you know, markets up and down, the recession, the possible economic concerns, rising interest rates, uh, they aren't a factor, at least not in our retirement.
That's quite the mindset you have, and and I'm sure myself and all our guests are looking forward to see how we can also have that same mindset with the approach that you have, and we'll get into that as well. Now, a quick note to our viewers: you can hear more about Henry's investing journey in our past webinar, how we developed our unique investing styles, and you can too. It's available on our Learning Center on Webroker and on TD's YouTube page. All right. So before we get into the meat of our conversation today, just a quick note to our viewers. We're going to be discussing Henry's personal approach to income investing and his retirement plan. They're based on his personal circumstances, goals, and needs. They aren't meant to be taken as financial advice that's broadly applicable. So take his experience as something to consider in your own investing journey. And with that, let's get right into it. So what made you start investing on your with your own money and gravitate towards income investing specifically then?
Well, by the time we got to the mid 40s, maybe later, we began to realize that, we didn't have a lot of savings. We were out of debt, uh, you know, so that was good. And, but we didn't have a lot of savings. So we started to put money aside. But it wasn't until I accidentally came across an article written by Tom Connolly, and he published the Connolly Report. And in that article, he stressed the point that you should learn to invest for dividends, and you shouldn't buy or invest in a stock that doesn't pay a dividend. And secondly, you shouldn't buy a stock that doesn't grow its dividend. So that was the stepping stone, and that's what got us into at least thinking about income investing.
Now, you started later in life with investing. So, and you do mention that, you rely on this investing income for, or dividend income, I should say, for your retirement years. So how long did it take you to reach the point where you were confident that you could retire on the dividend income stream that you had built?
Well, we started thinking about dividend growth investing. I guess about 55, maybe a little bit later. We tried to uh, generate about 45 or $50,000 of investment income by the time we were 68 or 65. I'm sorry, right? And you know, by the time we got totally into income investing, we stuck to the strategy that we liked. We achieved that goal at age 65. So that was about an 8-year period. We continued to at least do some part-time work at home. I was able to work over the internet, remote, what people are doing today. Uh, and I continued that on until I was about 70, 71. And during that period, that 5-6 year period, almost all of our dividends were reinvested. And we were continuing to add a little bit of money to our investment. And then by the time we were 71 or 72, well, our income far exceeded our retirement needs. And from that point on, we never had to worry about outliving our investments. And the nice part was we could see that income growing as we got closer to retirement. So it wasn't a situation where we said we needed 50,000 or 60,000. We could see the income growing every year. And as we got closer to deciding to retire, we knew whether or not we were going to be able to meet our retirement expenses. Generally, our own personal expenses will be in the range of $65,000 to $75,000 a year. And again, that includes Canada Pension and all security. So we didn't need a full $75,000 of dividend income to live off of.
As investors, you commonly hear about the type of investor you are. Are you an income investor? Are you a growth investor? Can you just unpack that a little bit more for our audience? What does it mean to be an income growth investor for those of us who may not be familiar with that?
Income invested means that for every dollar you invest, you want to earn an income. And the longer you hold those investments, you expect that income to continue to grow. Every time you add an investment or every time you reinvest your dividends, your income increases. And you can see that happening every quarter, every year, and it's a continuous. And it doesn't matter whether you invest a small amount of money or whether you can afford to invest larger amounts. It's just the amount of income you receive. Obviously, the more you invest, the greater the income. But the theory is that you want the income to grow continuously, regardless of whether the market is crashing.
You've been in the market, invested in the market for quite a bit. You've been retired for more than 15 years, as you mentioned. And through this time, you've probably experienced multiple recessions and market downturns. So how do you handle these events as someone who relies on their investment portfolio for income?
As long as if you're reinvesting a portion of your dividends, and because we were fortunate enough to have more income than we needed by the time we retired, we were able to reinvest a portion of our dividend. So we always have been. I still reinvest maybe 45, 50% of our dividend at 81. That means that our income is possibly growing. When the market dips or drops, that means I'm buying more shares with those dividend reinvestments. And then next quarter, I'm going to earn even more income. It's kind of the reverse. When the market goes up, I'll buy less shares. But when the market's going up, well, that's when companies tend to increase their dividends more often because the economy is being bad. So it's a win-win situation. If the market's going up, I earn more income. If the market goes down, same thing, I earn more income. So market fluctuations really don't enter into the picture, and they don't provide any concern, at least not from my perspective, about my retirement income.
And I also like whenever you have these sort of down markets, they're feast, as you said, for income investors, because you average down not only on your cost basis, but you're averaging up at the same time on your yield in case you already have an existing position on it as well, right? Now, as it relates to just dividends, and since you are income oriented and you mentioned you are looking for those quality dividend stocks, there are a lot of stocks in our market that do pay dividends. So could you take us through some of the specific criteria that you use to narrow down your list and your research process to identify that short list?
Yeah, I think I take a little different approach than most investors. Um, over the years, I kind of looked at how we invested, how our investments were doing, and I wanted to simplify the process. I didn't want to look at financial statements that were put out every year or every quarter. I didn't want to do continuous analysis on stocks. So I looked at how we were doing and which stocks or which types of stocks provide us with the most consistent return. I'm talking income return. And I really came up with what I call the 4 rules for evaluating a stock. And the first one is that if a company cuts the dividend within the past 10 years. Secondly, look at stocks that have paid a dividend for a minimum of 10 years. And that's a bare minimum. I prefer stocks that have paid a dividend for 25, 50, 100 years, right? Without cutting their dividend. Thirdly, companies that have consistently raised their dividends. Now, they don't have to have raised it every year. They just have to provide a consistent history of raising the dividend, maybe 8 out of 10 years. All right. And then finally, a dividend growth rate of about 75% or higher over that 10-year period. Right? So using those 4 rules, you'll eliminate probably 60 to 70% of the dividend stocks that are available, at least on the Canadian TSX. Use those rules to try to identify what I call quality dividend growth stocks. Then go back and look at the companies in each sector or group them by sectors and then rate them by quality, which ones they think are the better stocks. And by doing that, you can then narrow your list down to about 20 stocks, maybe 15 to 20, right? And that's the whole purpose of the what I call the 4 rules of evaluation, is to come up with a list of stocks to consider.
All right. Well, Henry, thanks so much for providing that criteria that you use there. And I like how it's simple and refined there to just use it as a bridging point. I know we overly complicate things with adding fundamentals, but that's a good starting point for us to use. And we're actually going to jump into WebBroker because we want to tell our investors how they can start their research process for researching stocks that pay dividends. So let's dive into the platform right now and show you how it's done.
Okay, once we have logged into WebBroker, we're going to bring up our screener tool to be able to filter out some of those dividend growth stocks that we've been chatting about. So to do that, we're going to click on the Research tab at the top. And within the drop-down menu, in the third column that says Tools, we're going to look at third from the bottom, and that's going to give us access to the Screeners tool. Let's go ahead and click on that. Once you're on the Screeners tool, we want to set up a custom screen. So we're going to click on Screening right on this page. Once over here, we want to clear out any other filters that might be set up in the system. So we're just going to make sure we hit clear all over here. And I like to just add my filters all at once. So I'm going to toggle over the switch that says bulk edit. Now we've been chatting about growth stocks, and we're going to try and implement some of the criteria that Henry has spoken about so far. So let's go to more criteria, and this is going to bring us a list of all the different filters we can apply to screen for the universe of stocks. We're going to focus and keep it simple, just as Henry mentioned, and focus just on the dividend side of the stocks. So within the dividend section, I'm going to add first the dividend coverage criteria. Now within the dividend the dividend coverage criteria. This is one that we haven't spoken about. So this ratio really describes how much of the dividends represent part of those profits that are being paid out. In other words, it gives a clue to investors how much room the company has, maybe to perhaps increase the dividends in the future. So it's taking the earnings per share or EPS number and dividing it by the annual dividend that the company pays. We want to see at least a 50% coverage ratio on this case. So you can simply go in the box and type in 50% at the very least. The next criteria we want to add is dividend growth rate over a 5-year average. Henry has usually looks at a 10-year average. We only have a 5-year average, and we're going to distill that number down. Henry looks at 75% growth over 10 years. We're going to bring that down to 35, basically half that value. So about 35% there is what we want to look at and see a 35% growth in the dividend over a 5-year average period. The final criteria we're going to add is really to just look at a comparison between the current dividend compared to the previous year and see if there's growth there. So in this one, we want to see at least a minimum of 5% growth on an annual basis from the previous year. Now, once you have that, it's going to spit out a number of results for you, but we do want to filter it just for the universe of stocks in our market. That's the Canadian market. So I can go up here where it says exchange and select Canada. And once I select Canada, it's going to just bring up some of our Canadian stocks. And there you have the results, the 7 stocks that are eligible based on this criteria. Keep in mind, folks, we did keep it very simple. You can implement further criteria to narrow down the search, and make sure that, just like Henry, this is just a starting point. You still want to do your research and find out exactly what these companies do and how they make money. So that's something that can just to get you started with looking for those dividend growth stocks here.
So, Henry, I wanted to ask you, now that we've come up with a short list of stocks with the research criteria, how do you then decide to invest your money amongst those shortlisted companies?
And like I said, if you have a list of 15 or 20 stocks, those are the only ones you consider. So every time you have money, regardless of whether it's 500, 1,000, or $5,000. So all the dividend stocks have a range. They'll average between a high and low yield. But you take their average, compare that to the current yield based on the current price, and then you have a yield difference. So if a company has a 4% long-term average yield, well, you don't want to buy it when it's only offering a 3.5% yield. You want to buy it when it's offering a 4.5% yield or a 5% yield, right? And you'll look at the stocks that are offering a reasonable yield, which is above the long-term average, and those are the stocks that you'll consider buying. You may not want to buy one that has a 4% difference from its average, because that may be too high. The company may be in trouble financially. It may have a debt situation. But you have to look at that. But a reasonable yield is one that is, say, 1% or 1.5% above its long-term average. So regardless whether the market is rising, whether you're in a bull market or a bear market, there'll always be 1 or 2 or 3 or 4 stocks that will offer you a reasonable yield above their long-term average.
So let's talk about yield. You mentioned that quite a bit, just so that everyone has a firm understanding of it. What makes a company's yield go up or down?
So yield is just a measurement of the income, how much income you're receiving every time you invest in a stock. Say a company pays a $1 dividend. Well, when the price drops, your yield is going to go up because you're getting $1 for less money. But when the price goes up, your yield drops because you're paying more money for that $1 of income. You see, if the company increases your dividend, then it automatically increases their yield, but likely the price is going up as well. In fact, if you look at a long-term yield chart for a quality dividend growth stock, well, a stock that paid a 4% yield 10 years ago probably pays a 4% dividend yield today. But what has happened is the price of the stock has gone up with the dividend increase.
And I think that that's very true, because it goes hand in hand. And I think a lot of investors may not understand where dividends come from, but they're paid out out of a portion of the profit of the company. So of course, if the dividends increasing company, if they're increasing the dividends, that means they're increasing the profits and therefore returning, shareholder value. So great point there. You mentioned dividend reinvestment or DRIP a few times. So could you tell us, like, when you first started investing, were you heavily focused on dividend reinvestment? And then did you kind of shift later on to then take off the DRIP and maybe just take on the cash or cash out the amount that you were getting?
No, I've always been an advocate of dividend reinvestment, whether you're buying full shares or whether you can buy fractional shares like company DRIPs. Because and in most cases, when you're starting out or even when you're in early retirement, the dividends aren't that large. It might be a couple $100, maybe even $1,000 or more. Well, I like to get that money reinvested immediately. I like to buy more shares immediately. That means that next quarter, I know I'm going to earn more income automatically, regardless of the market.
Absolutely. And I wanted to just give a note to our audience on that topic of dividend reinvestment. So for any of our clients here at TD Direct Investing, on any stock that does pay an eligible dividend, you may be able to do and enroll that stock into the dividend reinvestment program. And the advantage of doing this is that it's done commission free. You're not actually having to pay for having that dividend reinvested back into that stock. So it is it's advantageous that way rather than kind of leaving it in the account and waiting it to trade on your own. The other thing that you also have, and Henry, you might have heard of the term of compounding growth because of dividend investment. It's considered to be what do they say, the eighth wonder of the world as compounding investing. So you have that added benefit as well there. Now, I wanted to also talk about some of the criticisms behind dividend growth investing. So some of the critics out there would argue that investors need to accumulate a large portfolio to comfortably live off dividend income exclusively. But you disagree with this. Why is that?
Most investors will tell you that if you want to earn $40,000 of income, you might have to have a portfolio worth $1 million because the assumption is that you can earn 4% on $1 million to get that 40,000. But I have a chart, and it shows that if you had invested the maximum amounts in TD Bank for the past 14 years, the income is growing every month, the dividends are being reinvested, and that yield is growing slowly. It may not grow every year. There may be years when it drops, but in the long term, that yield will grow. So at the end of 14 years, that TD investment is yielding 5.91%. If we continue to invest and reach the point of $40,000 income, well, if it stays at 5.91%, I would have only had to invest $670,000, not $1 million. But realistically, because the yield is going to continue to grow, and it's going to grow because of compounding, because of you're reinvesting those dividends, you're adding more investment to that account, you're growing your income. When you grow your income, your yield will increase. You're going to earn more money with less money invested. In the long term, you're going to earn 7.5%, 8%, possibly even higher. And if you earn 8%, that means you only need $500,000 to earn $40,000 of income. So suddenly, you only need half as much as what most people believe you need.
Yeah, and I love that chart that you presented there. That's certainly one for us to consider, especially when you're looking at compounding growth. So fantastic. Let's talk about some of the risks now. Now, we know that no investing strategy or retirement plan is perfect. So what would you say are some of the risks with your approach?
There really only is one risk, and that's the possibility of a company cutting their dividend. And, that's the reason I'm kind of strict on the 4 rules. And by trying to stay with the best quality stocks, the companies have a long history of paying and growing their dividend and have done so consistently for years, you minimize the possibility of a dividend cut. You might never eliminate it. There might always be a chance that one company will cut their dividend. You invest in 15 or 20 quality companies. Well, if one company cuts their dividend or 2 companies cuts their dividend, that's not going to really seriously affect your income. If all of our companies cut their dividend by 50%, I would still have enough income to meet our retirement needs. And so, that's the ultimate goal for income investors, is to see their income grow to the point where they exceed their retirement needs so that the risk of a dividend cut isn't going to seriously affect their income.
One thing about investing, and I guess part of retirement income planning, is to try and minimize the tax bill from the investment income where possible. So, what's been your approach to keeping that tax bill down?
Yeah. I was probably a little less concerned about taxes all the way through. I probably could have done better had I looked closer at my investments and decided which to draw down from. And we were so happy earning more income than we needed. I sort of ignored the fact that our RRSPs and our risks were growing, and the income in those, especially in the RIP accounts, they exceeded our minimum withdrawals. I thought that was great. But what I didn't realize till much later was that at some point, I'm going to have to pay taxes on all of that income and all of that capital within the RIP accounts. And the tax would have been about 40, maybe 50%. All right. Certainly at the time of death, then you have to close out your RIP accounts and the total amount is taxable. Right. So what I should have done is I should have put less money in our RRSPs and more money into our non-registered. And certainly you would have to claim the dividend income as taxable, but it's taxed at a much lower rate. And so we decided to begin closing out our RIP account. But I think I wish I had put more money into our non-registered and paid the tax little higher tax today, so that I wouldn't have to pay a much higher tax later on.
Now, we've talked a lot about dividend growth investing that can help investors build an income stream in retirement, and WebBroker can be a handy tool to help you keep tabs on that growth of the dividend income and estimate how much you'll receive each year. So let's take a moment to hop into WebBroker and just show you exactly how that projected income tool works.
We're going to click on the tab at the top that says Accounts. And in the first column, which says Account Details, second from the bottom, you'll see it says Projected Income. We're going to click on that. This is the tool that, as mentioned, is going to help us see all the investments that we hold in specific accounts that are paying some sort of income, either through a dividend or an interest payment. So as you can see, when you get down to the tool, there's a graph that you can observe. And within this graph, it gives a breakdown of each month over here. And as you hover over each month, as you can see I'm doing, it shows us what the projected income is going to be for that month. Now, one assumption this tool does make is that the investment amount remains consistent, as well as the income amount that you're getting paid in order to make this projection over here. So apart from looking at the graph, over to the right-hand side, we have this informational box. Now, within this informational box, what you can do is, first of all, select a specific account by selecting account if you want to look at one specifically, or you can look at it on a grouped basis. So you can either look at them all your non-registered accounts if you have that. If you have registered accounts such as a TFSA, RSP, RIF, you can look at them all grouped together. And then you can, of course, still look at them individually. We're just looking at an individual account for the time being. Aside from the total amount, it gives us a breakdown of how much of that income is based on dividends and how much of it is based on interest. And you can see the breakdown that's given here. So dividends are those that are being paid by stocks, and interest is usually from products like GICs and bonds that you receive. And then it further gives a monthly average over here for us to allow us to really see what that projected amount is going to be. If we go further down, it breaks it down by individual investments to tell us exactly how much of those total amounts are being contributed by our individual positions in the account. Now, within here, what you're going to see is in a similar manner, you have it based on each month going out for a year from today, or this month, I should say, rather. And then it also gives us a column on the far left over here, which tells us the total amount that's expected to be received over the next trailing, or I should say forward-looking 12 months. Now you can also see here when the expected next payments are going to be for these individual investments. So for the first one we have, which happens to be a bond, we can see the next payment is going to be set for November, and then another payment is set to be for May of 2024. Now, additionally, within the projected income tool, you do have the totals at the very bottom for each month. So you can see certain months might be lighter versus other months might be heavier. So this may be part of a strategy to see and choose investments that might make up the shortfall in certain months. But you can also do a sorting function and see which of these investments is reaping the most amount of income. So if I go to the totals over here, I can do a sort and I can see this is in an ascending manner. And this is going to be in a descending manner, telling me the highest income producing investments I have down to the lowest.
Now, this is kind of a lighter question. I've got to ask you, my curiosity is piqued. Why keep reinvesting at this point in your life, Henry? I mean, you've got all this excessive income. Why not just enjoy the money? Go on a beach, have a few margaritas, go on the golf course in Arizona.
I could do that, but who knows what's going to happen? Fortunately, I'm 81 years old. I'm in good health. I haven't got any serious problems, at least none that I can remember. But, a year from now, 2 years from now, something serious could happen. And, if I didn't have that income base, and if I didn't have that capital available to me, then who knows if I could afford to meet whatever expenses I might need to live in an assisted living or care facility or meet whatever expenses that might come up. This way, I'm earning more income than I need. I'm spending as much as I have the money to do what I need to do.
All right. We're going to leave our conversation here for the time being, Henry. Any final thoughts you'd like to share with our viewers about investing for retirement income?
Well, I think the one thing every investor should do is look at their options. They should learn about investing, look at the options that are available to them, and decide what type of investments they want to do. A lot of people would prefer index investing, passive income investing, or they might want to just go with one. But take the time to learn about investing before you begin. And hopefully, they'll consider income investing as well.
Absolutely. And that's what we produce these shows for, to help people, upskill their financial knowledge and help them along that path. So thank you for sharing that with us, Henry, and your chat. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our TD YouTube page. See you all next time.